Good afternoon, everyone. I'm Miguel Morel. I'm the CEO of Arkham Intelligence, which is a blockchain analytics platform. Today, we're going to be talking about cryptocurrency intelligence and the future of on-chain data. So first and foremost, I want to give a little bit of a background on on-chain analytics in general. I think many people are familiar with different kinds of data research, due diligence, but doing research on chain is a very kind of particular element of doing research that is specific to crypto and doesn't really exist in other markets. And so I'm just going to go a little bit through some of the techniques that Arkham uses in order to gather intelligence. This is one of the kind of key questions that we tend to get. You know, how is it that you guys do what you do? And while it's relatively straightforward, it's not always very simple. So I'll just go through a few of the key points. The first is that we do a lot of data aggregation. This basically means actually finding different data sources from where we can gather information and do analysis of different cryptocurrencies. So without this sort of info, it's impossible to get labels, for example. And so if you are running a on-chain analytics startup, obviously the first thing that you would go to in order to aggregate data is blockchains themselves. This means going through Bitcoin, Ethereum, whatever kind of platform that you support, and actually collecting as much information as possible from those blockchains in order to then run analytics on them. But in addition to blockchains, you can also find information from other publicly available sources, social media, core documents, these sorts of things. And so that's kind of like the data aggregation component. In addition to this, Arkham in particular and some other blockchain analytics platforms also focus on visualization. This is a different way of analyzing information. You can look at it in sort of like a data dump or list kind of format, but being able to actually visualize the information will show you connections that otherwise would not have been obvious. Because we're analyzing a lot of information all at once, we also utilize machine learning, which has now kind of been popularized in the form of the terminology of AI. Prior to the AI boom, many people were just talking about this in terms of data science or machine learning. And we essentially use this to, at scale, be able to identify different kinds of addresses and their respective owners. Next, we have the address labeling itself. So obviously, when you get the raw blockchain information, you're just looking at a bunch of different addresses, but the addresses don't have owners. They don't have names attached to them. And so this is where we come in and actually do the work of labeling the addresses themselves in order to give people information about the ownership of the address. Next, we have address clustering. Address clustering is essentially the ability to take one address and then find other addresses like it that belong to the same entity, same individual, same company. So this is when you're looking at different patterns of transactions, of other kinds of metadata or information associated with the address in order to see what are the addresses that are closest to it in terms of their properties in order to then associate them together to the same owner. And then lastly, we have address modeling. So this goes beyond some of the other things that we've just discussed, but instead you take the different properties of an address and you're able to make an identification based solely on its transactions. So for example, if you have an address that is constantly receiving from many different addresses, but then only sending to a hot wallet, you could potentially identify that as a deposit address of an exchange, right? So even if you don't necessarily know who the owner is, you could look at this address, you say, okay, this address is only sending to hot wallets, it's receiving from many different counterparties, it's getting funded by a gas deployer, this thing behaves like a deposit address, and that would be modeling it as a deposit address. And there are thousands of different kinds of blockchain classifications for the sorts of addresses that exist, even if you don't necessarily know who the owners are. And at the bottom, we have a visualization of what it looks like to take raw blockchain data that maybe is not that useful, but is highly transparent, to the Arkham visualizer on the right, which is incredibly useful to a bunch of different people. So what does Arkham do with all of this blockchain related information? What does it actually allow our users what does it allow them to do? What is Arkham's function? Arkham's function is to give people a holistic picture of the institutions and individuals behind crypto market activity. The market does not move on its own. It moves because there are different companies, people, trading firms, exchanges, governments, etc., moving these coins around, and that produces different kinds of market dynamics. And so the more that you can study and analyze this, the more you'll understand why the market is doing what it's doing, and therefore you can either protect your portfolio, analyze your risk, or in some cases make trading decisions or investments based on this information. And so Arkham in particular, we give people the ability to see others' portfolios. So that includes the assets they own, their current holdings, and the implied net asset value. Their balances over time, so that means the prices at which they purchased cryptocurrency or sold, their daily profits and losses, and the cumulative P&L. And then lastly, we give people an idea for these different entities and their transactions, so who they received from, who they sent to, and their usage of exchanges, as well as a bunch of other services. And these transactions and all of the information that I just mentioned can often be used to explain or predict market movements and behaviors. Now, this transaction data and this on-chain analysis and analytics, it doesn't exist in isolation. On-chain analysis and on-chain analytics is not a silver bullet for being able to understand and completely, become a guru of the crypto market or any market for that matter. It's one tool out of a larger toolbox that can be used in order to become a better trader, risk analyst, risk manager, etc. So often we tell people that they should be using this info in conjunction with the other types of analysis that people do, which would include, as an example, fundamental analysis. So this is, understanding the project, understanding the founding team, understanding the tokenomics. Technical analysis, this being price data, this has become extremely popularized over the past couple of years. This is the sort of trading view style of trading where you're looking at different price charts and the lines that are being plotted on the graph. And then you make your decision about whether or not you think the asset is going to go up or down in value. And then, of course, there's our information that we provide, which is the on-chain analysis and transaction data, which is actually what positions particular people are taking, who are the new entrants into the market, who's exiting, exchange inflows, outflows, etc. So let's look at a quick case study of Bitcoin ETFs. So Arkham, we mentioned a couple months ago, identified all 10 of the Bitcoin ETFs. And so, as a matter of fact, essentially what this does is all of the information about these ETFs previously existed off-chain, right? When you're analyzing anything in the stock market, this doesn't exist on the blockchain. It exists in the centralized servers of the New York Stock Exchange or wherever that particular asset is being traded. That information is often not updated in real time. Almost never is it updated in real time. Generally speaking, this information is updated perhaps daily, perhaps weekly, monthly, or very often quarterly in SEC reports, for example. However, what blockchain data allows us to do is that as these transactions are being made, as Bitcoin is being purchased, for example, it is being settled on-chain in real time in a way that can be analyzed in real time without needing to wait for a centralized party to produce a report that you can then analyze later on. So this is an advantage or an edge over traditional market analysis in the sense that you could very quickly price in information about what's going on in a publicly traded ETF based on blockchain analysis that is happening in real time without needing to wait for the issuers of that ETF or the stock exchange or whatever to update their information in their database. Additionally, in real time, you can track the inflows and outflows of these different ETFs to watch how much is coming into the ETF versus how much is coming out. And that then gives you a sort of pattern of behavior for which you can expect the price of the asset to go up or down, right? If you have significantly more inflows, significantly more people buying that particular asset than you have selling, generally speaking, you would assume that that increase in demand against the supply would cause an increase in price, versus the other way around. When you have substantial net outflows, you have significantly less demand compared to the supply, and therefore potentially it could be more likely to go down. Next, we have BTC mining. So a bunch of the largest Bitcoin miners globally are actually listed on publicly traded exchanges, either in the United States or abroad. Canada, for example, has a number of them. And very frequently, the revenues of these producers is stated in these quarterly reports. They will mine a bunch of Bitcoin, make money. They have assets and expenditures related to that particular quarter. And then every 90 days, they will issue a report similar to other publicly traded stocks where then they say how much money they made. However, if you know that the way in which they make money is by mining Bitcoin, and all of the information about the Bitcoin which they have mined can be found on chain, why do you need to wait for them to tell you how much Bitcoin they've mined and therefore how much money they've made? You can actually just identify these people on chain, see how much Bitcoin they're mining in real time, and then watch as they begin to liquidate that Bitcoin on exchanges, and therefore you're able to then predict what their revenue is likely to be. Maybe you don't know the other side of the balance sheet, which is the expenditures, but for that you can use more traditional methodologies of research in order to get at least that part of the equation. And so in using products like Arkham in order to identify these miners, you can see significant amounts of information about the amount of revenue that they're likely to produce in a given quarter before they're actually releasing their earnings reports, for example. This is an example of miners receiving Bitcoin and then sending them out to different exchanges or trading firms. Now, the most recent one, which you guys have maybe seen in the news, was our identification of the German government's wallet holdings for Bitcoin. A number of governments currently hold Bitcoin or have been receiving Bitcoin or selling Bitcoin over time, including the US, UK, the German governments, and El Salvador. We've actually produced dashboards within our platform which allow people to see all of the different government holdings in real time in order to then have a sense for what they're intending to do with their portfolio. And so this information is very important because these governments, they hold a lot of coins, right? So they have a lot of assets, and when they decide to sell substantially, in many cases, the on-chain analysis itself may not even be what's relevant. What could be relevant, rather, is people's reaction to the news that these coins are being sold. I think there's a lot of different arguments for why it's important to have the information. Some people say, okay, well, if the German government holds $1 billion of Bitcoin, but Bitcoin has $30 billion of volume every day, then why is it a big deal? It should be that, over time we're able to absorb this kind of market impact. To that, I have two responses. Number one, oftentimes a lot of this volume can be spoofed or potentially not accurate. There may not actually be that level of liquidity on the exchanges to be able to absorb this amount of volume all at once from a big seller. And second, it may not be the 1 billion of Bitcoin that actually impacts the market. It could be the 50 billion of retail who sold because they heard that the German government was selling $1 billion. And in anticipation of potential losses, they decide to get out the door first, right? And so oftentimes you have to make a decision as a trader about whether or not you think the news itself is going to be the thing to move the market or not, or potentially what the masses or the public's response to the news and information is going to be, and whether that could potentially be the market moving impact instead. So here, for example, we have a number of different transactions from the German government seizure. So the German government received all of this Bitcoin from a website that they ended up shutting down and then forfeiting all of the assets from that website. They then held these coins, over $1 billion of it. And then afterwards, they are now sending it to different OTC desks and exchanges, including Kraken, Coinbase, Cumberland, etc. And this information then does things like it makes it on the news. And after it's on the news, obviously a bunch more people see it, and then they end up making trading decisions based on the information, potentially panic selling. And those are the kinds of things that can create drawdowns, if not the selling itself. So what are some of the reasons for why we've decided to create a platform like Arkham? Well, crypto is often attacked for being opaque and unsafe, and therefore people determine that it needs to have heavy regulation, right? In a world where you don't have, SEC filings and things like this, very frequently people believe that this is one of the reasons why we need regulation for crypto. I think that's not true. I think crypto is actually significantly more transparent than traditional markets when you have the tools to be able to analyze the information in real time, such as Arkham. I think additionally, tools for obfuscation make it such that large institutions like banks, for example, are very hesitant to go into crypto markets or accept funds that have an original source in crypto. But then tools that bring transparency like Arkham actually allow you to independently be able to trace the origin of particular funds. And assuming that those are clean, then you should be able to onboard significantly more customers without necessarily saying, no, this market is opaque, therefore we won't accept anybody who holds crypto. The primary goal of regulators, at least what they say, is to protect investors. And tools such as Arkham give investors the ability to do better due diligence and actually analyze what's going on with the supplies of the tokens that they're investing in prior to them investing in them. And lastly, as a sort of fundamental thesis, price is driven by the dynamics of supply and demand in a market. And blockchains have given us the ability to, in real time, be able to detect the supply and demand of different crypto assets in a way that isn't possible in more traditional markets. And that's our presentation on Arkham. Thank you.